Top is Chief Global Investment Strategist at Charles Schwab. He joins us now, and it's great to see you, Jeffrey. And I know that you've been fielding a lot of questions from your clients about how one is supposed to look at such a story of uncertainty and make sense of it right now. What's been your perspective?
You know, on the geopolitical risk, it's really an ever-present part of investing, and there are times when it flares up, and we all feel the impact, and the human toll is not measurable and unimaginable. But the market impact of these types of events, and unfortunately, we have a long history to look back. We have 50 some odd years of attacks in and around Israel. 23 of them, the market's reaction has tended to be fairly muted initially, and then usually within 5 days having fully recovered. And one of the reasons for that is that we rarely see oil flows being disrupted. You know, if you think back to the invasion of Ukraine by Russia, that did have the risk of displacing global oil flows from Russia. Russia supplied 10% of the world's oil. And so you saw a much bigger spike in energy prices and a bigger impact on the markets. This is now just a risk to global energy supply tied to Iran and other areas in the region. And so far, those risks are unfounded. Oil continues to flow, and Saudi Arabia has a spare capacity to bring it online if they need to. And that is one of the reasons why the market's reaction has been fairly minor.
And I guess, as a number of energy watchers have said, looking to countries like Iran and their continued comments on this subject is going to be worth watching, because obviously further escalation raises more questions about the supply story. But that's helpful context. Maybe you can give our audience some context on the broader market story. You know, we're sitting here, we're now into almost the middle of October. It's been a choppy few weeks for the equity world, and I think a lot of people who want to stay committed to stocks are trying to figure out where to be positioned. You know, tech had that big run up here in Canada. We've talked about how the Canadian market overall has struggled this year. What are you watching within equities right now?
You know, today's news from the big banks in the U.S. is probably as important as any economic data point as we look at the broader economy. What was really interesting is that while there was some sign of increasing credit card losses and related losses given the rise in interest rates, overall, JP Morgan, for example, reduced the pile of money they had set aside for potentially bad loans by 113 million. Analysts had expected a reserve build. Wells Fargo said the same thing. They reported a $1.2 billion new provisioning for loan losses, but that was less than analysts expected. So it seems that while the rise in interest rates is leading to further delinquencies, charge-offs, bankruptcies, we know this, banks seem to be adequately reserved, more than adequately reserved perhaps, for these losses. And that's relatively good news. And one of the things that's maybe offsetting the negative geopolitical tone and the rise in oil this morning is that it looks like consumers are maybe faring a little bit better than many analysts expected in the face of these higher rates.
So I hear you talking about banks. We don't have earnings. We're on a different cycle for the Canadian banks, but they do make up a pretty big chunk of the Canadian stock market, along with oil related stocks. How do you feel about the TSX? You know, if you were looking for an investment in Canadian stocks versus U.S. stocks, how would you feel about that kind of positioning going forward?
Overweight Canadian stocks versus U.S. stocks. Not only you mentioned the financials and the energy exposure, which I think are two sectors that we're most attracted to right now. And so that alone is a positive. But Canada is a secret outperformer right now. Canada has been one of the best performing global stock markets this year. The average Canadian stock is outperforming the average U.S. stock this year, something investors who only focus on the capitalization weighted averages might be missing out on. In fact, the equal weighted MSCI Canada index is up about 5% so far this year. That's nothing to write home about, but the equal weighted S&P 500 is flat this year. And that just shows how concentrated the gains in the S&P 500 have been around those 7 mega cap stocks tied to AI. If you take those out or you look at the average stock, it's really pretty flat. We're seeing much better performance out of the Canadian market. I think that's likely to continue over the remainder of the year.
Okay.